And there it is. The markets are officially closed on this Friday, August 30th. Welcome, investors and traders. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. Not much has changed from last Friday with regard to my price targets. If you had a chance to watch my midweek report, you'll know that my downside targets are still in place. But I do have some added commentary here. If you take a look at today's candle, you'll see that is a hanging man. A hanging man candle is one of the most bearish candles. 80% of the time after a candle like that shows up, the markets tend to drop. In addition to that, you can see that we have a wide divergence from that 20-period moving average. We have a drop in volume on the way up, which signals that the buyers are losing some of that momentum. And you have a negative divergence here in the stochastic oscillator. That is when you have a higher price high, but the highs on the oscillator itself are going lower. That's a negative divergence. And so downside target, again, still in place for DIA right there as I get that data box pop up at $400.52. Moving right along to IWM, which is a small cap ETF. You'll know that last week I said we would most likely go higher Monday, Tuesday. We did that. And now we are on our way back down, downside target at 206.47. We've got the same signals showing up. Hanging man right there. And we have the drop in volume with a wide divergence from the moving average. The one added point that I'd like to show you here is that down below on IWM, we have an open gap. Gaps fill 80% of the time. Like we saw back here, this was an open gap. It filled. This was an open gap. That too filled. 80% of the time, gaps fill. Don't take my word on that. Go back and look at any chart you like, any ticker symbol. Go back and count the number of gaps and then go back and register how many of those gaps have filled. Now, the other thing about gaps is that once those gaps fill, prices tend to reverse and go the opposite way. So again, that downside target still in place for IWM right down there at 206.47. Moving right along for the Qs, which is the tech sector. What do we have here? Hanging man right there as I magnify that. See, it's a small body candle with the long shadow underneath. Again, we see a drop in volume. The oscillators are already moving down. For the Qs, we're closer to my downside target than the other ETFs. So I do believe that downside target will hit sometime next week as we start to move into September and October, which are the most notorious months of the year. That downside target is 461.69. Looking at SPY, again, it's pretty much going to be the same story. We've got another hanging man right there. I said we would move up. The upside target hasn't quite yet hit, but I do think we'll get closer to it. And then next week, we'll start to see prices move lower. Remember, Monday is a holiday. The markets are closed for Labor Day holiday. And therefore, we're going to have a thinly traded market, which makes the price action more open to, I don't want to say manipulation, but it can move more easily when the market makers push it one way or the other. The big difference here on SPY is that we had a higher volume day. That is not uncommon when you see a hanging man such as that, because it's usually telling us there's a battle going on. We see, a lot of time we'll see a selling climax like we see here on higher volume, and a lot of times we'll see the battle go on at the highs with higher volume. So we're seeing that right there. Moving right along down below, you can see again another negative divergence, lower highs on the CCI, lower highs on the stochastic. So downside target right there, SPY is 543.88. Now I'd like to bring your attention to the VIX right here. I do believe we're going to see that upside target hit within the next couple of weeks. That's 23.89. Take a look at where the VIX is wound up over the last couple of weeks. We're just going sideways. It's more or less consolidating on these lows. Whenever you see that, you generally see spikes after the consolidation has taken place. And you can see that back here where the price action moves sideways, and then we had that big spike. Now, I'm not anticipating a big spike like what we saw here a couple of weeks ago, but I am expecting the upside target to hit right there again at 23.89. Now I'm just going to take a quick look backwards again, but now looking at the monthly charts. I want to show you again. Remember, I was talking about the hanging man candle. If you look at this, being that today's the last trading day of August, what do we have right there? A hanging man candle right at the top. What do we have with IWM? Well, guess what? We got another very long shadowed hanging man right at the top. We look at the Qs. What do we have? We have another hanging man, and of course SPY is following suit with another hanging man. It is not that common for us to see those types of candles right across the board. If you look back here, when we had this hanging man right there, that was at the end of August, beginning of September. There was a hanging man where the markets pulled back. If you look back here, this again was a hanging man right at the top. And you can see that hanging man candles are very closely related to the shooting star candles, which are as significant to the downside. So when you have shooting stars right there, followed by a hanging man candle, you have to watch out. What did we have last month? We had a shooting star in SPY, followed by a hanging man. Stay tuned to Sticky Trades because these market reports are worth more to the novice trader as an educational tool than it is to the advanced traders. Remember, my percentage of accuracy is over 81% on every single stock I've analyzed, including the major market ETFs. If you go as a member to our Sticky Trades page, you can go to our rapid fire stock analysis page right here, and you could put in your own ticker symbols. If you look at, let's say, Mara, this is one that I've analyzed many times before. Mara, we have a good high percentage of accuracy, almost 93%. In other words, out of the last 28 times I've analyzed that one, it's hit the target 26 times. If you look at IWM, for instance, which is the major market ETF here, we have 6 out of 6, a hit rate of 100%. If you look at DIA, which we don't have come up too often in the Rapid Fire Wednesdays because I do that on Fridays, but we got 100% hit rate on that. So as a member, even if you come in with a free 15-day trial, you'll have access to this by simply going to your dashboard, and then you could click on the Rapid Fire analysis here. Right there, it's the third one down from the top, and then you could put whatever ticker symbol you like in there, and it'll show you the hit rate. Now, I recommend people use this for trading because it's most likely the targets are going to hit with stocks that have a tendency or a high track record for hitting targets. That means that those stocks are more likely to follow the technical signals. Now, I use the 7-point trading checklist. It's something that I put together for our members. I weigh the evidence between the bullish signals and the bearish signals. And when I'm picking stocks personally, I look at the number of bullish signals, and the more bullish signals I have going on that chart, the more likely I'm going to go with an upside target, and vice versa. If there's more bearish signals showing up, obviously I'm going to go with a downside target. Now, I'm going to also invite you all to use your gifts of discernment. What is that? Well, when we're looking at the data, especially when it's coming from our government, whether it be the Bureau of Labor Statistics or the Congressional Budget Office, whatever it may be, use your judgment and connect the dots. What am I talking about here? Well, last Friday, Jerome Powell noted that the timing and the pace of the cuts that they're expecting to the downside will depend on incoming data. Well, if you looked at the jobs report last week, that wasn't so accurate, was it? And in fact, if you look at the Gobesi letter, which is on X, it notes here that 7 out of the last 9 times the revisions have been to the downside. And I joke about this, but I also am very serious about this when I say if I was an accountant work for an accounting firm and I had to revise 7 out of the last 9 reports, I'd probably lose my job. But this is what investors are depending on. This is what traders are looking at when the data comes out. So be very careful. When I say connect the dots, what I mean is collect all the data that you're looking at, and then you tell me if it matches up with what you're hearing. Here's a great example. Yesterday, Dollar General put a pretty bad sales outlook into the future, and the stock came down 32%. Now, does that match up with what we saw a couple of weeks ago with the blow-away retail sales? No, it doesn't. So you have to be on guard when you're looking at the data. Of course, the price action is going to most likely react in a knee-jerk reaction when the news comes out. But when the investors start to crunch the numbers and the institutions start to look at the numbers, it's a much different picture when they start to correct after these knee-jerk reactions. Now, if the Fed does pivot and we start to go lower, I want to, again, draw your attention to what's happened in the past. In the great financial crash in 2007, right before the crash in 2008, the market dropped 50%. Now, this is the S&P after the Fed pivoted. If you go back and you look at what happened with the dot-com bubble, well, that was in 2000. This is the S&P. Again, you have to understand that in 2000, the markets dropped 38.3%, but the tech sector dropped even more. The tech sector dropped 50% after that came out. And in 1989, you have to remember back here, this is when the market had already crashed in 1987, and the Fed pivoted after that, and the markets dropped another 4.4%. Now, again, that was in addition to the crash of 87 that we saw. That was my most memorable crash in the markets because as a novice trader, I basically got wiped out. And in 1988, I came in with the 1% rule, and I have not had a losing year since 1988 because I follow the 1% rule. This is what I teach our members, is how to manage risk and not allow the market to take money from you. Again, so you can see how this works out on the chart. When the Fed pivoted in 2000, what happened? The markets dropped, and the pivot took place before the actual sell-off followed. You see, so if the Fed is starting to talk about pivoting, and even if they cut rates at 25 basis points, forget the 50% basis point cut. If they just come in with 25 basis points, then it's game on. And we're probably going to see the markets drop. That's why I have not lost my downside targets on the Qs, the IWM, the diamonds, SPY. Have not lost sight of my longer-term downside targets, which are pretty extreme at the March 2020 lows. But I'm telling you right now, it's not a matter of if it will occur, it's when. And I think we're right on the cusp of the market starting to pivot lower into September and October. Now, again, look at the numbers, right? Pay very close attention to the numbers. One of our VIP members, his name is Tim, he and I had a conversation about this yesterday because I wanted to get my head wrapped around the new home sales versus the pending home sales. He's in real estate. I'll give a shout out to his company, Bear Mortgage. They're very much on the lender's side. And I said, Tim, how is it on August 23rd, new home sales blew it through the top with 739,000 when the estimate was 624,000. Well, he explained to me, this factors in the developers and the builders who are coming in. They're building homes, they're selling their homes, so this is going to be reflected more in new home sales. But guess what? 6 days later, we hit a record low on pending home sales. This was disastrous right here. So you look at the differential here with new home sales blowing it out of the park and record lows coming in on pending home sales. Well, that tells me there's a bubble forming in the real estate market. It means that inventories are extremely high. They're going to have to move their inventory. Otherwise, they're going to start losing money. And if that bubble pops in the real estate market, you're going to see a lot of action and a lot of investors, especially going out and taking hits on the portfolio. Now, personally, I believe that it's going to be great for the new home buyer, as they're going to have to lower their prices if they have such a big inventory. And if interest rates start coming down with inventory prices starting to come down, new home buyers, watch out. I think you're going to be in for a good market. That's just my spin. I'm not a real estate expert. I'm looking at the bubbles that are forming, and I'm just telling people, watch out. I think you're going to have a good time of it, especially if you're a brand new home buyer. Now, if you go in and look at what's happening with the trucking industry, remember we were looking at the jobs report. Jobs report had a miss of 818,000, but if you're looking at the employment on the trucking end, we have an aggressive fallout here as trucking companies are just not hiring. And that's usually a sign of recession that follows. If you're following us now on ZeroHedge, stay tuned. I have a chart of the week coming out either Sunday evening or Monday. Stay tuned to ZeroHedge. You could look under the contributors tab and you'll see the chart of the week there with my content added to the chart. Now, finally, before we wrap up, I want to tell you that there's a great report out there through the SRS Rocco report on X. And he did a great job calculating the cost of silver to the miners as they pull it out of the ground. Now, I was expecting silver to drop to around the $23 level. If that happens, I'm going to be a big buyer. There have been many times when the price of silver has dropped below the cost of mining silver, and I look at that as an opportunity to buy below wholesale. Think of it that way. So keep your eyes on silver. If the chart of the week comes out featuring SLV, which is a silver ETF, I'll definitely let you know. And I also trade silver. So if you follow me on X, just put in hashtag AJSLV trades, and you'll be able to follow my trades as I post it on X for the whole world to see. I keep it very transparent, and I give the general public a chance to buy it even before I do. I do not use my audience to push prices around. I'll make the announcement that I'm going to be buying. I'll tell you when I'll be buying. I give the general public a chance to buy ahead of me, not after me, and that gives you a leg up or an advantage on trading silver. Folks, have a very happy Labor Day weekend. Thank you so much for joining. I look forward to speaking with you again. I will most likely not be putting out the midweek report on Wednesday because Monday's a holiday. We'll only have one more trading day after this report here, so it doesn't make sense for me to follow one day later. So I'll have the next report coming out at the weekly market report time pretty much after the close on Friday, next Friday. So thanks again. Have a great weekend. I'll talk to you later. So long.